Good afternoon, everyone. Welcome to Shadow Trader FX Hour. I am Blake Young, taking you through the next hour as we discuss all things Forex and everything that's going crazy in the market in the Eurozone thanks to Greece. We'll get to that here momentarily. I want to remind you that you can follow us by going to My Trade and search for all the Shadow Traders through here. You'll see we have the Swing Trader, FX Trader, Paris Trader, and Weekend Update and videos. And that FX Trader is how you follow me, and that's where you get your daily commentary, notes, updates, calendars, etc. We saw some major swings, some monster swings today we're going to get to here momentarily. This is recorded. This will be posted to shadowtrader.net website. Under shadowtrader.net, look for archives, look for FX Hour, and that is where you'll find this archive. And my email for Shadow Trader is fxtrader@shadowtrader.net. If you want to ask questions, put comments or thoughts along the things that you would like to see and know more about. I'm going to drop this down into just a chart now so you get a better, cleaner image. And we can move forward with what is going on in this market. There we go. So you should be able to see my S&P chart. You have audio but no video. Have you clicked on watch? Click on watch. And let's see. Let me just double check. Can everybody see my image? Okay. Okay, very good. That's odd. There's a bigger delay than normal. All right, so there's S&P. So one of the things we're watching is we're seeing that there's a major risk-off situation. I think this is the reason why we have seen the euro go up. We are seeing risk-off, and what do we do when we have risk-off? When we're looking at things move and we see things change, and we're looking for elimination of risk, one of the things you will find generally is you're going to find that we are... Let me turn that down a little bit. We are going to see people destroy, take away, remove higher risk, higher leverage positions. When we are short something, we short cover. When we're long and it gets too extended, we start to cover that or take those profits off. And so covering the yen short and the euro shorts, as Money is talking about here, that is what's going on. We are seeing a major short covering. Now, not on the S&P. The S&P has been up, 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 and we've traded flat for so long. We've traded flat all the way through. If you want to go back to January 1 or January 2 officially, you can see that we are right back at the same level. We have made absolutely no money in equities over the last 6 months. So here we are finishing the 6 months, and we've seen no profitability in equities. And so we're gapping down, we're falling down. The markets are not willing to commit, and they're not willing to buy in to any major move. And we've seen that major move try and fail and try and fail and try and fail every time we hit these highs, and now come back and we have a flat candle on this. According to the futures, we are as flat as you can get. We are a gray candle, we are at the open, and here we are waiting for the default of Greece, which time's up. It's time to get out. It's time to kick out the euro or the Greek from the euro, or kick out some money to protect Greece and keep them in the euro. So as we jump over to the euro US dollar, what we saw is we saw the initial response, which is we should be killing the euro. We should be sending it lower. We should be beating it down and slamming it down into the ground, which is what we started out with on the open. In fact, we gapped down and paused right at the previous resistance, and resistance areas right through there. And as we watch that stall out and stop at that resistance area, acting as support, the market said, whoa, this is really scary. And as we saw that really scariness, remember, they are already short. If you don't believe me, go pull up the Commitment of Trader report. You can get that from the CFTC, and you can pull that Commitment of Trader report, and you'll see that we have tens and hundreds of thousands of short euro positions. When we got scared and we see things move and see things change, they cover the shorts. And covering the shorts in large quantities pushes it right back up. So the initial gap, which we don't normally have gaps. We have gaps only when we have a new bit of information or a shocking bit of information happen after Friday's close in the U.S. markets. So we had that happen, and the negotiations crumbled. Everybody is expecting the negotiations to be really controlled and everything fine, and we're going to come up with a solution, and that's where we traded. Now, after that, we gapped down, we unwound it, and put it right back to the same area that we were at last week when we expected some sort of deal. And that's why we're here again. Now, I do believe that we're going to have a little bit more volatility. I believe that we're going to see a little bit more short covering, but I think long term we will see some weakness in the euro. And so I want to sell it here around 113.25 or up here at about 114.75, 114.90, call it 115. And those areas are where I'm going to look for an opportunity to sell that position. I'm going to look for an opportunity to sell euros and get long US dollars. Now, today's down day does not convince me that we're obviously going back down. You can see we've played right back to the previous trend support and right back to these lower shadows in spite of that volatility. Now, I think you're right. I think we will see some money move into bonds, and we will see some controlled low risk trades going on. And so as we're watching this, we want to watch for the bond prices to move. And so jumping over to the U.S. Treasuries, so we look at the ZB, you can see that yesterday we gapped up to start the day and closed higher. So we saw money move quickly into the bonds as a safety. As we look at the ZN, today we're offsetting that move. So we look into the ZN, even more dramatic as far as a gap up to start the day, pushed even higher. In fact, in one day, we went from what would have been a weekly low or 2-week low near the multi-month low up to a 1-month high. And then we fell back down and we're here at this level again. So as we're watching this, we are definitely seeing some money moving into bonds as a safety. Now, can the bonds go to the moon? That's a good question. As we're watching this and we're looking for bonds, and we're looking for, as Russell says, we're looking for bonds to be driven higher and higher and higher. Is it going to go to the moon? No, probably not, because remember, we still have an opportunity to raise rates in the U.S., and that's still on the table. And we're going to come back to the ZQ here in a minute. But we're seeing that that's the case, that we're seeing money move into the safety. Even the, call it the ZF, 5 years, even the 5 year short-term treasuries, back up it goes. It's ended the downtrend, it's ended the bearishness, and as you can see, breaking through the resistance, resistance, and resistance. I've got 3 solid closes there. I could do the same thing on the shadows and look for that as well. But as I'm looking at the 3 closes on this lower line, you can see we gapped above it and we've fallen back and we've retested and stopped right at that level. And so if we find that as a potential bounce and a continuation on the gap, if we bounce here, then we expect strong moves in bonds across the board. If we can come down below this shadow, then I would expect it to fill the gap and fall back down to this level down here. But rising prices, especially going back to the ZN, rising prices in bonds, if we can get this to continue to go bullish as a safety. Remember that rising prices mean lower yield, and lower yields mean that banks can theoretically lend cheaper and people can borrow, and that still is a stimulant to the U.S. economy, theoretically. However, this is being driven based on fear. Even if they're lower rates, do the banks lend? Short covering, Wacko's short covering means that they've been in short positions against the euro. And so it's not that they're buying the euro in confidence, but they're actually moving away from a risk position. They're getting out of a position that causes buying of the euro, not necessarily because they don't like the dollar, but they're causing buying of the euro. Buying of the euro to cover the position, not buying of the euro because they hate the dollar. And so as we watch that and we look for that move, that's temporary. Yeah, and as we look at these things and we see higher risk and more uncertainty, doesn't matter that the things are cheap. It doesn't matter that they can borrow at 0.25%, or if rates drop down on the long terms, look at the TNX. As we look at the TNX, it's not that we're talking about the TNX going down to 2.1%, meaning that we're saving an extra 0.25%. That's not going to make a significant difference. It means the banks potentially can make more money, certainly, if they lend. Are they willing to take that risk? That's the big question. Going over to the dollar, as we look at the long-term trends, the dollar against multiple currencies, the super long trend, this could be a ginormous, if we go back to the weeklies, we talked about this, a super flag. Huge trend, big consolidation. As long as it doesn't pull back more than half of that super trend, that big, monstrous super dollar, then I would be still willing to look at this to swing higher and get back up to these highs as we watch fear in the dollar. Now, the problem with the dollar getting stronger is what? What happens when the dollar is getting stronger? If it gets stronger. Right now we're still in consolidation. It's not there yet. But if the dollar returns to its strength, if the dollar becomes stronger again, and if the dollar is the safety, and we see money move over there and away from the other instruments, what then? And I would say you have a couple of ways to look at this, by the way. Oil goes down, gold goes down, commodities fall. It is, whether the economists will admit it or not, or whether they'll be afraid to say it, it is disinflation or deflation. And if we have disinflation or deflation, that is a problem. Dogs and cats sleeping with each other, total chaos, right? That is a major problem. Monk says, Vice President Chair commented today, interest rates hike will be discussed in every FOMC meeting. Pretty dovish comment. Yeah, we're already planning on talking about it, which is our translation as we're not doing anything. We're not going to do anything about it. Let's just keep on moving. So as we're watching that, that's very dovish. Let's go back really quickly, and then we got to do a bunch of currencies. I'm going to go share our trade tab so you can see it. I have to move it like this so I can see it. One second. There we go. Alright. Now you should be able to see my chart again, and now the trade tab. So we're going to go over and look at the ZQ, speaking of the dovish comments, and then we're going to go through a bunch of currencies and futures and metals, where they might go, what that means for ag and metals and oil and everything else. And Mary, absolutely. Not that I generally align myself with him, but a strong dollar, a very strong dollar, means the markets aren't moving. A strong dollar, remember the markets are quoted in US dollars. So even if things are appreciating in value, I can't roll up my sleeves like he does, so that's why I can't align myself with him. Even if the dollar is appreciating in value, or the equity market is appreciating in value, if the markets are appreciating in value in 1, 2, 3% increments, well, the dollar's purchasing power going up by 2, 3% offsets that gain. It's quoted in US dollars. And so if the dollar gets stronger in its purchasing power of goods and services, and then everything that it's quoted in is going to be dampened in its growth by that same percentage of strength. So looking at it really quickly, let's go through and let's see where the market's pricing it in. Notice our October price is getting further away from that 99.75. We're kicking the can down the curb, or down the street anyway. As we look down, November isn't now. If you recall, you'd have to go back and look last week. But if you recall, November was at 99.45 and something. Now we're at 99.74. Now it's at 99.76. This is what October was. We've now moved the expected date of a rate hike to November instead of October. Have you ever noticed that he gets extra mad when the market's not doing what he thinks it should? I go back to Socrates. And the idea there, he said he was the wisest of all the philosophers. Do you remember this? This is what caused the apology and everything else that had to. Maybe you don't know your Greek history, but we'll throw you back into that view for just a second, and we'll come back to the charts while I do it. He went around, and he was told by the Oracle of Delphi, or Delphi, however you want to pronounce it, that he was the wisest of all philosophers. The wisest of all. And he'd said, I didn't believe it. So he spent his life, or not all of his life, but a considerable portion of his time, going around trying to validate or prove that that was wrong, that he wasn't the wisest. So he went and found the wisest of all men and women, and would ask them questions, and ask them more questions. And then he finally came to the conclusion that said, I must be the wisest. And the reason why is not because I actually think I'm wiser, because it is because I know and acknowledge what I don't know. Rather than yelling and screaming at the TV, I go with the idea that, hey, I know what I don't know. I know when it doesn't work. right? There's wisdom. Know what you don't know. Don't get mad when the market doesn't move the way you expect it to or doesn't fit the exact your definition of the economic expectations. We put the odds in our favor and then watch to see what happens next. So as we look at this, as we watch gold prices, as you're looking at the gold chart here, gold prices come back down, and we see that it's struggling to get up at all, and it's rolled back down. In fact, if we zoom in on this and we look at the close price over the, well, going all the way back, this is the lowest close price since March. If we edge down a little bit more, it would be the lowest close. We're coming down to retest it. So the lowest close price is 1171.80, and we're at 1172.60. We're 80 cents away from giving us the lowest close. Now, as we're watching this, if gold is selling off, remember gold is down, and it's not. Is it because we have excess supply? Do we have too much gold sitting around? That may be part of it. Could be a little bit of that. But more likely than not is that we're not expecting inflation. We're not expecting growth. That we do not see a need for inflation hedge when one country after the next is struggling. And we're not seeing the economic data to say that we're seeing the growth. And then when we look at commodities, specifically going into, let's go into the, you said ZW. Someone posted ZW here a minute ago. When we saw that commodity futures were down, well, not wheat, not corn. By the way, this could be a beautiful reverse anchor. If you want to get an expectation of this move, had a downtrend, higher lows. As soon as it came above this higher high, we could anchor a reverse fib fan off of this one. So let's go see where that's going to go. I wonder if they were at the top. When it goes too far, we duplicate one more time. Trying to get the line up there. There we go. So where's our top side target? We might get up here the next couple of days or weeks and get back up into the 677 and get to an annual high on corn or on wheat. Let's check corn. ZC, and then you'll see something very different. We looked at corn, we looked at wheat, big moves. The higher lows here are even more aggressive. It's not 10 days apart, so normally I wouldn't anchor it like this. It's too tight, but you can see a similar situation. This does not meet my standard. We still have an upside here on corn, and I wouldn't be surprised to see us over the next 2 days get up to 445. But when we look at DBA, Deutsche Bank's Agriculture Fund, which includes corn, which includes wheat, we're still in the bottom half of the year. We're still in the bottom 20 percentile. Yes, we're seeing a big rally. Agriculture prices are rising. Now, we talked about this last week. We talked about New Zealand. And we talked specifically about the fact that they are struggling. The dairy farmers are bankrupt. Now, the fact that we're seeing wheat and corn and everything take off, it is definitely out of balance. As we're looking at everything take off here and rally up and see it coming off the bottom. Let's go back percentage-wise. As we look at the move from the bottom to this current price, we've rallied 7.6% in 14 trading days. Call it 3 weeks. It's awesome. It's great. But when we compare that to the fact that it's dropped in the year 22%, what would be a 22% drop, this 7% rally is good, but it's got a long way to go. How long does it take? This is what I commented last week. Do you recall what we talked about? The problem that New Zealand's had is as they sit on the sidelines when they can't sell their dairy and they can't get the prices, they still have to feed their cattle. Now, this is not the best instrument to use because we're not dairy cattle and live cattle are not the same, but you can see that cattle prices are low. But as we look at this and we watch this price action through here, and we see the weakness that is in the cattle, and we look at that and see that way down, and we could look at a couple others here. Oops. Try that again. Coffee, way, way, way down. Sit tight, Dan. We'll be right there. You're okay. We'll get to you. Coffee. Oops, cocoa. way down today, but after reaching near its highs. And got to hit copper. Well, let's hit sugar first. Oops, that's sugar. Sugar is ZS. No, that's soybean. Soybeans are up. Has a little bit way to go, but to get to the resistance, but coming off its low again, about 7-8%, actually 12% on soybean. Way to go, soybeans! Today alone, major jump. What is sugar? Can't remember sugar now. Anyway, let's go to copper. So ags are going up, metals are going down. So if ags are going up, remember what we started talking about last week. That last week, when things are getting rough, things are going down, things are getting very tight, they start going into bankruptcy, they can't just turn on and off the faucet. They can't say, yes, I didn't plant because I didn't have any money, but now I planted. They can't say, well, I didn't feed my cattle anymore, but now I'm going to because prices are going up. They have to continue to incur those expenses. ZB, thank you. They have to continue to incur those expenses no matter what. So it takes time for them to recover. Now, as we're looking at this, I agree with the idea of ag is going to keep going up. Here is your opportunity on the New Zealand, but when? We are at an annual low. In fact, we hit that annual low today. Go back even further. We are at a 3-year low. Not only are we at a 3-year low, we are at a 5-year low. See that? So as we're falling and hitting lows and new lows, let's see how far back we have to do to find a low. Right here. June of 2010. So we are, what, 6 years? We're going into 6 years here. Now, these are candles from monthly candles. We could hit that. That is the only support level we have, even on the monthlies, until we drop down to this level, which is 59.14. If you want to look at the shadows or the closes, we could do the same thing. And then we're all the way down to 50 cents. Now, as we're watching this, we are continuing to fall. Do not catch the falling knife. As we're watching this roll over and continue to go lower, as we go back to the, let's go to the 3-year weekly to start out with. As we're looking at these moves and these trends, let's go ahead and anchor the high close to these closes through there. Let's duplicate that drawing. Let's bring it down to these lows at the bottom, and let's look for that extension. That would seem to me that we could find that over the next 3 weeks, find a support near 65.50 off that multi-week trend line. That's a channel pushing us lower, and we can look at that extend to the right, where these two intersect next week, end of next week. Yeah, amazing what flooding in the Midwest will do to the ag prices and drought in California. Right, and as we're watching those, the question is, again, how long before they get enough benefit to offset the costs and losses that they're dealing with? Now, if you're feeling confident with the fact that agriculture prices are going higher, and we are seeing a major turn there, as we're looking at those, general commodity prices are down. Gold and, well, oil's still flat, but gold and metals are down. But ag prices are climbing. So as we're watching this, maybe we go through and we look at the highs, the high shadow, and say, let's at least trade through the resistance area, or trade through the close above that close if we cut that off. But I still like the idea of letting it drift a little bit lower, letting it find a discounted price right around 65, and looking for that as a potential bullish buy opportunity as we watch this fall. Now, one of the most extended pairs that we have right now is the pound New Zealand. Now, the pound has been gaining partly because it's been a safety for the Eurozone, but partly because crude light has been able to maintain. And they have cheaper oil prices in Canada, so they're doing better in the 67 or 57 to $62 range than Canada does. Canada is making money through here, but BP is doing better through here than Canadian oil is as far as margins go. So we did have a bounce today, but not super strong. We had a lot of sell-off recently. I would say overall we're still neutral on crude and have been for the entire month of May and June. But we're watching to see if that's going to go the other way. But when we look at the pound New Zealand, this is probably one of our most extended and hyper extended charts that we have. As we watch this, we created a monstrous double bottom in this, and this is the price pattern that we could have watched and set up. Watching it from this key support, notice I'm hitting the more significant support levels. This close, this shadow, this close, this close, these closes, and coming up to the highs in between, right through there. And now I'm going to duplicate that drawing, drag it up, and anchor it right on top again. So if we are going to see an extension of what we already saw on that double bottom, we already rallied to it and broke through there with gusto. We've stalled at this Fibonacci. We pulled back and found that Fibonacci again. So I think this is a good way to look at it, that we're testing the key support areas and resistance areas on the Fibonacci's all the way up off of this double bottom. Notice we keep stopping at the Fibonacci's, and that's where we put in supports and resistance. We didn't stop at this one, but the rest of them we have. We've stopped at every key support and resistance level on the Fibonacci's except for this one. And now we've accelerated, paused here, fell down, broke out. Now the expectation I would have is the pound New Zealand is going to push higher, just like we saw in the New Zealand US dollar, falling down a little bit further, and then we're going to be looking for it to get up to 236.41. Now 236.41 is an area of resistance that we would watch for that to reject and fall back down. If we want to look at the trend associated with that, we'll grab a trend line, and we can wait for at least the bullish trend to end if you want to. This is not a catch a falling knife, it's more of a don't catch a speeding bullet. As we're looking at this one, or a moving train, whatever you want to call it. We've got the longer term trend off of this line. Let's edit the properties on that one. I'm going to turn this one into red. That is definitely the time where you might look at that as an end of that trend. But this one is the shorter term trend. And let's change that one to blue, just to make it more distinct than the other trends. So if we close below this line, I'm going to expect it to fall back down to this level. So watch for a test by, what would that be, next Tuesday, Wednesday, right around 236, and then fall down. Now, should that tie in with the other? If the pound is going to strengthen, let's put all these pieces together. Look at the New Zealand US dollar. And Mary, why do they buy? Why would you buy currencies as risk aversion? What do you do with your equities, your bonds, gold, silver, copper, when you get nervous? If you feel like the market is overextended, is going to fall apart, what do you do? In your own personal account, we go to cash, right? We get out of positions. And getting out of positions is actually demanding that cash. Do you remember when the tsunami hit Japan? When Japan was hit, you would think, oh no, this is going to be terrible. It's going to cost the country a lot of money. They're going to have to rebuild, and that means the value of their currency is going to go down. But what happened is everybody wanted cash out of the banks. There were runs on the bank, not because they expected the banks to fail, but because they needed cash. And so there was higher demand. They liquidated assets, they liquidated equities, they liquidated other things, and selling everything else, going into cash, or getting their cash out of the banks is an increased demand of that item. Any increased demand with a static or decreasing supply increases in price. And so the value is that they were increasing the prices as that goes. Now the New Zealand US dollar, we talked about it going down to this level right here, about 66, let's call it. Oh, hang on, I got to zoom out. I can't even see it anymore. Got to go to the 3 weeks. There we go. We talked about it going to 65.65. Now 65.65 from where we're currently at on the New Zealand dollar, if we get that one push lower, we're talking about a 2.9% drop in the New Zealand dollar, 2.9%. As we go over look at the pound in New Zealand, if we're looking at a 2.9% climb here, you'll notice it's only 1.6%. And so what I'm looking at is I'm like, wait, 2.9% down on the New Zealand and a 1.8% up, 1.7% up in the pound New Zealand. Theoretically, theoretically, I like that one. As we're looking at this, if the New Zealand is going to decrease by 2.9% and the pound is going to increase by 1.8% against the New Zealand dollar, that means there's a discrepancy. And as we're looking at that discrepancy, that means we should see some weakness in the pound to the tune of about 1% by the time that happens here. Now the pound dollar has already rejected its resistance line and pulled back. We are still looking for a push higher, but we're looking for a temporary push higher, an equal high, maybe the 1% up, and then that fall of 1.7%. So I'm looking for the pound dollar to come down to about 156.11 after another push higher. So I'm looking for one push higher, strengthen the pound, moving away from the euro, potentially into the pound more than the US dollar in a knee-jerk reaction. Going to that horizontal high, and that combination should be that we should see the pound US dollar falling down to 156.11, and that still allows the pound New Zealand to get up to that high. Yeah, baby sheep. One of my favorite sayings is that I took that trade and then that night I slept like a baby. That's right. I woke up every hour crying. Euro New Zealand. Similar. We already tested this high. This is also a reason why I'm waiting for that euro to give me a clear sell signal, because I do feel like we're extended to this point. Now the euro New Zealand can get stuck here. And it could get stuck here for a period of time, because remember, even if the New Zealand dollar is losing to the euro, or sorry, losing to the US dollar, it could be losing to the US dollar and losing to the euro, and it might be a little push higher here. So if we see this move, let's do the same components, the same percentage game. If we see this move from where we're at to trend high over the next day, I'm only looking for 1 day, maybe 2 day. That's 1.87%. Remember that we're still looking at a similar move down of about 2.9%. So if this pair rallies 1.87%, that's euro strength, New Zealand weakness, and the New Zealand dollar falls 2.9%, that's euro or New Zealand weakness and dollar strength, the euro US dollar can still find its peak and roll over. So as we're watching over the euro US dollar, here's it, and I know you came in late, a couple of you, so here's the euro US dollar. The euro US dollar has fallen right back to the support area. Now, I could clean this up a little bit. That close, not that close, this close, and this close. Right through there at that support level. We've sold off and we've stopped at that key support. As we're looking at that, stopping at that key support, that short-term shadow, I'm still looking for a bounce. I'm looking for it to get up to about 1322. If I can sell at 1322, I feel like my risk, my cost, my danger in this trade is fairly minimal. For the opportunity to be able to trade the euro short, even if I had to put my stop all the way up here, theoretically, I'm risking 200 to 210 pips for the potential, if I can sell at that resistance, to at least come back down to the low, which is 837 pips. So I've got a 4-to-1 reward-risk ratio on that situation. And a 4-to-1 reward-risk ratio, I only have to be right 1 out of 5 times if I can get that same ratio every time. And Mary, I'd agree. Gold is just a currency. There's nothing magical about gold. It is a currency just like any others. It's just less liquid. All right. Yeah, original Constitution said a lot of things that after amendments they didn't say the same thing, right? Mary, I've run funds before. I currently only trade my account. Euro Aussie. Oh, and we need to go through all of our futures really quickly. Let's go 1 through 1. First, Euro Aussie. Off the closes. I'm going to cut through half of this candle just because I want to. I looked at this as a support area, so this was overshot. So if I anchor half that candle, hit that low, I like this one, which is not, it's not the prettiest. But you can see how we had previous resistance and support levels, and if I line all those up, this key support area here, this is either a fun-looking bull flag for the Euro Aussie to go long, and that would be from 140 up to about 147, so 700 pips potentially, or it's a really funny looking skewed triangle. So now if that is a triangle, we're talking about a move potentially of 1,168 pips. To be a little bit more conservative, I would treat it like a channel. Do you see this channel right through here? So from the high to the low close, I'd start off with probably 480 pips. So if I can break through this resistance, I'd look for 480 pips on the way down, which is going to take us right back into this area right there, where we had noise and consolidation prior. So here's the potential setup on the way down, and on the way up, I'd give ourselves a little bit more room. And that would be Euro strength Aussie weakness. And we'd be looking for that next bullish move higher. How do I get the price box to display percentage moves? On the Thinkorswim charts, if you're just using your drawing tool, and go to trend lines. I don't know if there's anything. I've never changed any settings in that, so I don't know if there is anything settings. It's as long as I don't anchor it, that's where that's going to be potentially set up. Let's go through really quickly. 100 billion pips, that's right. Let's go through really quickly all of our major currencies in both the futures and the currency pairs. And on it, so you're talking about, this is being your left shoulder is what I assume you're referring to. If this was your left shoulder, this is the head potentially, and this is your right shoulder. Do I got that right? And I know you can't see this because for some reason you can see it in the recording, but you can't see it in you can see it in the recording, but for some reason you can't see it in the live presentation. I think I have to share my whole desktop. Maybe that's what it is. The question is, where do we end the shoulder? And we could dip further. We could drop down to 142. We could drop all the way down, maybe even to our target at 139 and some change on the way down. And it still could create the right shoulder because it would still be higher than the head portion. And that would give you a monstrous head and shoulders. That is quite a significant head and shoulders on that chart. More like a frog. It's got the bulgy eyes, two different eyes. All right, let's go through really quickly. 6E, this is the Euro futures. You're going to see it looks exactly like the Euro US dollar. So as we look at the Euro futures, same chart. As far as price action is concerned, they're different type of contracts. Spot Forex is basically a 3-day rolling future that's simply rolling every 3 days and changing its pattern. The 6E is going to give us the same opportunities, same pairs, same moves. You can trade these in the micros, which are 12,500, and put you very, very close to the same setup as a 10,000 mini on the Forex market, on the Forex spot market. You're going to see some similar highs and lows through here. Now, on the long-term trend, I still think there is this breakout and retest on this one. We've also talked about it being a support level through here on the Euro US dollar. That's why I want to sell at a horizontal high. I want to sell a little bit higher, and if we do the shorter time frame, maybe in this area 1325, but preferably where our sell limit is already sitting right around 114.45, 114.50. Now that's what we show on the 6E. Same thing on the Euro US dollar. I just don't have that long-term trend showing that breakout. But if I do the same long-term trend, looking for that potential breakout, capturing as many closes as I can, you can see there's a breakout and retest, breakout and failure. So this apex, the problem with this long-term trend is if you get to the last 10% of that apex, generally you're not going to want to take that trade. It broke out before, but now we're right at that apex almost perfectly. I think it could go either direction. Line color is white. Which line color was white? Let's go to the 6B while you answer that question. This is the pound futures, and we'll do the pound currency pair as well. So when we were watching, instead we had these higher highs in this trend. And as we're looking at this, I don't necessarily, I mean, maybe a shadow comes up and tests this, where we had previous resistance and support through here. Line all that up. Maybe that comes up and tests 159.37, spikes up and retests there. But I'm primarily looking for more of the test right around 158.70. And I think that is probably where we create a double top. And if I want to be more conservative and wait, then I'll wait for it to test that area and then break through this support area. That little double top, even though it's only about 200 pips, I believe could turn this around and change it into a longer-term bearish trend for the pound. And the pound US dollar currency pair looks the same. Same setting, same target, same expectation. I still expect it to come up to 158.75. Maybe the upper shadow does test 159 or 159.50, but overall I'm looking for this to put in a double top, a reversal pattern, and break through this support level. Risk is low up here, but probability is better down here. Oh no, Truman, the reason why I can't see the line on the graph is I was using a drawing tool in Camtasia. That's what I was referring to. I don't believe you. I have to share my desktop instead of share the chart. And I don't know if you can still see it. Let's try that. Should we try it? Let's try it. The problem is it changes the whole screen. So you should be able to see my entire screen right now on the pound US dollar. Tell me if you can see me draw the red line. Can you see that red line? Yeah, so what's happening is if I share my desktop, you can see me make drawings. But then the whole screen gets distorted. So if I, you get a much smaller chart, right? So, and that just gives me, I could have drawing tools. However, like I said, then you have to see the whole screen. So maybe give me some feedback. Would you rather have this entire screen, or all stretched out and that way, or would you rather have, and that gives you the drawing tools, or would you rather have a more clear chart, where the chart is filling up that display and cleaner? Really? Desktop? Full screen? Interesting. Okay. So I've got quite the mix. It's full screen with drawing tools. Some that says you'd rather have the the smaller screen, where it's easier to see chart. It's kind of tough. You see, it's kind of one or the other. If I max the chart out, then that's going to also max out the broadcast, and that might delay the images as well. Maybe we'll try that next week. We'll continue as it is here, and then that way, if you want, we can do drawings as well. The problem is the drawings is they don't stay on there. And Monk's doing a count for me, and he's saying full screen one. So we'll do that. Remind me if I'm not doing it next week, we'll try it, and we'll try to change the entire dimensions of the chart. Okay. All right. I care what the people think. That's who cares. All right, let's go through. Let's hit the Aussie. We talked about the Australian dollar. We talked about gold falling back down, but the Australian dollar still looks like it's basing out, but it hasn't given us a real indication that we're going to change the trend. We've got consolidation for the past 4 weeks. We've got long-term trends that's been potentially down. So we look at the Aussie US dollar. It's going to be the same chart, same setting, same kind of idea, same weakness. And so this is a great example of the fact that a downtrend is ended does not mean you have an uptrend. It's Dow theory-esque. Downtrend ending does not mean uptrend. So you saw this downtrend, lower highs, lower lows. Beautiful Elliott wave, 1, 2, 3, 4, 5, and your corrective wave, A, B, C. And this could be 1, but now it can't be 2 because it's not Elliott wave. It can't fall all the way back down to 2, or down to the beginning of 1. So we have no pattern, no wave on that one. And so we just have this long-term support. Now this would be an inverted cup and handle. It's not, truly would not be considered a head and shoulders, because a head and shoulders cannot happen at support. An inverted head and shoulders bottom can. But this consolidation, this retest of support, this would be an inverse cup and handle. And that inverse cup and handle, if it can break through support, that means we'd be looking at weakness of 81 down to 75. That's about 525 pips, or 6.9% on the Aussie US dollar, if it breaks down through the low. That means we could be looking at a 70-cent price on the Aussie US dollar. That fits what we are seeing and expecting with the New Zealand dollar. So here's the New Zealand dollar futures, and we talked about it falling back down about 2 or 3% more to the next low. And that is another 300 pips on the New Zealand dollar. We've already talked about this one in detail, so I will spare you the revisit of the New Zealand dollar. It's still falling until it finds a stronger support or breaks this longer-term trend. So test 65.60 or breaks out of this trend. Just not willing to bet on it in spite of the fact that commodity prices are going higher. Now what we're going to get on this, on the 6C, is the inverse to the Canadian dollar. So as we're looking at the 6C, this is the US dollar, Canadian dollar, but it's CAD US dollar. versus the US dollar CAD. Yep, I will try to do that, Russell. All right. Yep. Trend consolidation, new trend, or trend downtrend, but end of downtrend is not necessarily a new trend, and that's one of the comments just being made. So trend consolidation, new trend. We need to see a true set of higher highs, higher lows to create a new uptrend. Now this 6C is interesting to me because this price pattern looks like it's potentially a head and shoulders when we're looking at it this side of things. But you cannot have a head and shoulders at the bottom of downtrend. But it has broken out. Do you see that? Support, 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 and breakout. We've had a solid breakout. So we default back to the previous trend. We've got to get at least 2 touches here. And even if we were to be a little bit more conservative and angle a very steep triangle, the distance on the steeper triangle tells us this could move 412 pips on this breakout. We've already moved about 60, but there's 412 pips from the breakout. That would push us all the way down off my screen, down into about 76.50. If we're looking at the bigger trend, the bigger consolidation, then we go to this second touch here, and that is 650 pips. I'm going to use my Fibonacci extension to measure that, and then we're going to go look at the dollar CAD pair, which will be the inverse of what we're seeing here. Sometimes it does add clarity to find these patterns in these breakouts on the inverse. It's a little bit easier to see sometimes because of the way it's compounded. But as we look at this, we're going to go to the Fibonacci extension just because I use this for a measuring tool, going from the high to the low close, and then I can use this as a risk management tool as well. And what that does, I need to zoom in this way. This gives us a target. If it breaks out 10% or closes outside the range, that's a trade. So theoretically, the Canadian dollar should be shorted, US dollar should be going long. And that's in spite of the fact that the gold or oil prices went up today. So the Canadian dollar weakened, breaking out. We've gone about 10%. Theoretically, it falls back down to 73.96. That's the Canadian dollar all the way back down to 73.96, and that puts us back in line with this long-term trend of bearishness for the Canadian dollar. Now, that does not mean the oil prices are falling or this is predicting a fall in oil prices. It means the Canadian economy or Canadian dollar is struggling. And you can see it's a little less clear here, but it is the same inverse pattern. Seemed a little bit easier to see it when it was right side up, right? So if I have the same consolidation, short term, the short-term pattern should be about 658 pips. This is a major trend. Or the short term is really here. Let's measure the short term first. Fibonacci extension. A really tight consolidation right through here. And this breakout, only looking to get us up to 126.33. Now we've already gone almost half of that. If I measure from this low to this high for the, I got to measure it a little bit to the right. If I don't want it to go to the left, I've got to measure it just off to the right a little bit. This gave us a close above and a 10% move, and the upside target is 130.53. Our previous resistance area on this dollar CAD pair puts us down here. I don't like that one. I'm going to cut through it, and I'm going to put it up through this area where we have this offset. That actually could overshoot it based on our previous resistance levels. It's not going to match up. So 130.50 would be the next high based on this consolidation, this price pattern. Last two majors, and then I see your questions. Let's see if I can get to as many of them I can in the 10 minutes that we have. This is the Swiss franc, like the Canadian. This is the inverse. So as we're watching the Swiss franc, I'd like to get rid of all that noise from this DPEG and focus on what is going on now. We broke through the trend. We treated old support as new resistance, potentially. Right through there. We came up and tested a horizontal high and broke out. If this was an uptrend, well, that was a lower low. This was the lower high. So officially, this began our new downtrend. If we're looking for a downtrend, we had lower highs and lower lows. And the fact that this tried to bounce and has reversed, this tells me I like the Swiss franc short against the US dollar, and maybe even like the Swiss franc short against the US dollar before I like the euro short against the US dollar. All I need to do is clear yesterday's candle, which is a lot closer than what we're seeing on the euro. So let's go to the dollar Swiss. This is the inverse. This is the previous trend and the breakout. Horizontal support instead of resistance. And you see we have to cut off a little bit there in the calculation, as the inverse is a little bit different. Just get above this high. That would give us through, see this little itty bitty head and shoulders? Left shoulder, head, right shoulder, breakout. We'd be looking at a move from 91.50 up to about 94.14, which looks like a tiny move because we covered it in a matter of 4 days, 5 days, but it's still 260 pips. And that 260 pips on that breakout would take us back above the previous highs and all the way back through here and truly set us up for higher highs and higher lows and continuation higher. The last one, dollar yen, of our major currency pairs. The yen, it's the inverse as well. Lots of weakness in the yen over the last while, but you can see we've created this reversal, and we've created higher highs and higher lows in the short term, not in the long term. Haven't broken the real long-term downtrend, but we have created this higher highs and higher lows. Now this could be an opportunity to that reverse anchor as well. Let me remove that one and redraw it off of the closes so I can get that nice trend line. We'll take the reversal of that fib fan and take our reverse fib fan. We need to do that again. It's been a while. Reverse fib fan. We've broken through the highs. We've closed above the highs, and so this tells me that we could see the dollar yen, or the yen dollar, rally to 0.008394. Now 0.008394, if we take the inverse of that, is about 111.85. Let's see if that's right. Had that breakout, potentially lower highs and lower lows. And the next major support level, boy, that takes us through 119 down to 116 potentially. Yeah, the 111.94, that's a way away. Did I do that wrong? 0.00894. Yeah, so it's got us projecting out to 112 even. Now, I would look for it to find support right through here and call it 118.88. 118.88 in the next week or two if we have increased volatility and bigger sell-offs. Now, that ties us back to, as Monk knows, my Aussie yen is my favorite currency pair for determining which way the markets are going to go. It's my greed and fear trade. So if I'm looking for the greed and fear trade, I'm looking for the major turning points in the Aussie yen. Gold and growth helps the Australian. The more demand for metals, basic metals, gold and the other metals, drives the Australian economy higher. Fear and uncertainty causes yen short unwinding, which strengthens the yen. And so when this is gapping down, we expect equities to gap down. We see it rally through here. We're expecting equities to push higher. This resistance area, the gap itself near 94.80, if that holds, then I'm going to expect to see equities bounce off a resistance area through there. Now you can see we had a big day of volatility, less bullish day, and so watch for this to fail at 94.80. If it fails at 94.80, then I would anticipate that that's when we're also going to see equities fail at a resistance area and roll over. Now I'm only talking about a small bounce. Let's look for equities to bounce tomorrow, continue, and retest 2075. 2075, and if it fails at 2075 tomorrow and can't close above there, as you can see today it didn't, and it kind of got close to it, but a little higher push, a little stronger bullish push. And then if we roll over by Wednesday or Thursday, then that is an area where we're retesting old resistance as new, or old support as new resistance, and I'd be looking for it to roll over, break through support, and then fall back to 2033, if not lower. Back to crude light. Like I said, small bounce. I'm not buying it. Meaning I'm not buying this as a breakout. It has to clear these areas. It's got to break out through here. You know, and I'd probably even be willing to go down here to about 56.50. That support, these resistance and shadow areas, it has to clear that before I'm a believer that crude's going to go long or short. We've already tested and filled the gap. Look at that. There's the gap from Monday. All the fear came all the way down, rallied up, filled the gap, failed, and came back down. Now, Berto, if you like the dollar CAD target, I think that's reasonable. From a pure price point pattern, 130.53, and you're saying it hits a previous resistance area. Yeah, keep in mind we haven't been into these areas in a while. These areas still are key areas. Look at that. 130.53. It is the highs of all of 2008 and 2009. We hit it 1, 2, 3, 4 different times. This is a key area for the U.S. dollar Canadian dollar. And you think, wow, well, that's the dollar Canadian is 130. That's the 10-year highs. And you think, oh yeah, it really is. That's pretty impressive. Okay, but when you look back even further, if oil falls apart, if we get back down below 55 and stay down there, the dollar CAD can get all the way up to 160, 180. We were there before oil prices hit and broke through 55. That's where they have profits. Yeah, nice validation. I love it when that happens. Love it when it lines up that way. So, lining up historic support and resistance like that and targets on price patterns, it just makes me feel more confident that we've done the correct analysis, that everything is lined up and we are good to go. That's where we expect to see things hit. I did see that Fitch downgraded Greek debt to a double C. What time is exactly the deadline? Does anybody remember? I forgot what time. Oh, it's in 45 minutes. So we still have 45 minutes. Going back to the Euro-US dollar, we'll finish up here as we're out of time. But as we go back to the Euro-US dollar, 45 minutes. Here's a 5-minute chart for you. Trading flat through here. Watch for volatility to kick this up. Watch for short covering. Especially as we get into that last little bit. We would like to sell a little bit higher. We expect a pretty big... Oh, yeah, and the leap second. Don't forget that, Monk. Absolutely. So, 4 hours at 6 p.m. Eastern, 6 p.m. .001, you got to get a leap second. Now, remember, that's the big deal there is not that we gain a second or we lose a second. The big deal is that it messes with the systems and how they talk to each other. So, that's something to pay attention to because it could get pretty choppy. All right. Overall, I expect volatility. I expect this to pop up. I expect one more push higher on equities as people look for safety. But then again, if it causes enough big long-term fear, as we talked about last week, remember the too big to fail and what that did to the U.S. equity market? Well, Greece is... You look at it percentage-wise, what is it, about $150 billion? It's like a company going under that is a $150 billion company. So, it is significant, and it is a problem. They've got to take some action, but the question is which way will it go? And unfortunately, because of how volatile I expect it to be, or how quick I expect the move, how big of a range I expect it to play out, I just don't know if we're going to be able to catch it. We're trying to be somewhat conservative on it, but we'll wait and see. And UVXY, up there on the volatility. This is the Pro Shares Ultra, means 3 times, or is it double? So it's a leveraged future. If you look at the VIX itself, 17 is an area that I've been watching, and you can see we cleared that yesterday. That takes us through the highest volatility going all the way back to February, but that doesn't hurt us necessarily. It just tells us there is opportunity to trade in trade options. More premium. All right, thanks everybody. Have a great, you too. Have a fantastic 4th of July weekend, everybody. And hopefully you have good time with your friends and family. We will be here next week Same time, same place. This is recorded and will be posted to shadowtrader.net under archives under FX Hour. And otherwise, have a great, fantastic, and successful trading week, everybody. Take care. And of course, thanks, JB. We'll take you out with the rest of that blaze of glory. And we'll talk to you again next week.